60 hours. That is how long precious metals markets are closed starting right now. No liquidity, no price discovery, no ability to adjust your position. And in that 60-hour window, the Iran conflict, which has already driven oil sharply higher this week, remains entirely unresolved. Gold is at 5,080, silver is at 85.40. And there is something happening inside the silver futures market right now that most people watching the headline price have completely missed. The May silver futures contract is trading below spot, not above it, below it. That inversion is a signal I want to walk you through carefully today because it changes how you read everything else. But first, last week I told you to watch the DXY at the 100 level. I said if the dollar index broke and held below 100, it would remove one of the key headwinds for silver, and the physical premium story would have room to develop. The DXY has firmed to 99.40. It has not broken below 100. That call has not triggered yet. Here is why I still think the setup is valid. And here is the specific thing that would tell me I am wrong. The 100 level on the DXY is still the line. If the Fed statement on March 18th produces any dovish signal, watch that level immediately. Until it breaks, the macro headwind is still present. That is the honest picture. I am John. 15 years in FX and commodity markets before I ever picked up a camera. I left that world because I believed the people sitting at home watching their savings deserved the same quality of analysis the institutional desks were working from every single morning. That gap between what institutions know and what retail investors get told. That is what this channel exists to close. Everything I show you today comes from publicly available sources, and I will name everyone as we go. If this kind of calm, evidence-based breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed, today is the day. Because what we are covering right now is time-sensitive in a way that most precious metals content simply is not. Today, you are going to understand exactly what a futures inversion means and why the May silver contract trading below spot is a structural warning. You are going to understand the mechanics of how a weekend gap forms and what the Iran situation means specifically for the Monday open. And you are going to get one clear framework for thinking about your position sizing going into this weekend. Not a trade recommendation, a framework that will serve you regardless of which direction Monday opens. Let me give you the full market picture as of right now, Friday, March 13th, 2026, because the context matters enormously for everything we are going to discuss. Gold is sitting at $5,080 per ounce. It retreated from its all-time high of $5,595 in late January, but it has held above $5,000 through a period of genuine macro headwinds, the DXY firming to 99.40 and the 10-year Treasury yield climbing to 4.26%, near 5-week highs. That combination would normally apply significant downward pressure to a non-yielding asset. The fact that gold is sitting at 5,080 tells you something important about who is holding it. These are not momentum traders. These are central banks, sovereign wealth funds, and institutional allocators who have made multi-year structural decisions. They are not checking the DXY every morning and adjusting. When you see gold hold above $5,000 against dollar strength and elevated real yields, that is institutional conviction, not retail enthusiasm. Silver is at 85.40s. It touched 88.38 earlier this week and pulled back. The pullback is the headline. What is happening underneath it is the story. This morning's PCE inflation data came in near 3%, the Federal Reserve's preferred inflation measure, well above the 2% target. The March 18 FOMC meeting is expected to produce a rate hold. The Fed is trapped between sticky inflation and slowing growth, and there is no clean exit from that position. And then there is the Iran conflict, which has driven oil sharply higher this week and injected genuine geopolitical uncertainty into commodity markets, at exactly the moment when the structural picture for silver was already under pressure. Drop a comment right now. Are you closing out any positions ahead of this weekend, or are you holding through? I want to know how this audience is actually managing the gap risk in real time. Here's what I want to focus on first because it is the least discussed signal in today's market and the most revealing. The May silver futures contract is trading at 83.87. Spot silver is at 85.40. That is a 153 inversion. Futures trading below spot. In a normal functioning commodity market, futures trade at a premium to spot. That premium reflects the cost of carry, storage fees, insurance, financing costs. You are paying more for future delivery because holding metal has costs. When futures trade below spot, that normal relationship inverts. The market is telling you that something about near-term physical delivery is either stressed, uncertain, or being priced with a discount for a reason. In 15 years watching commodity markets, I have seen this pattern in other metals at moments of genuine physical tightness. It does not happen by accident. It is the futures market pricing in a risk. The risk that paper promises and physical reality are not perfectly aligned. Think of it this way. Imagine you have booked a hotel room for next month at a rate lower than the walk-in rate today. That would only make sense if the hotel was genuinely uncertain about whether it could fill rooms at the current walk-in price, or if there was something about next month's demand that made future bookings less attractive to price aggressively. The futures market is doing something similar. The May contract at 83.87 is the market saying something about the forward delivery environment for physical silver that the spot price is not yet fully reflecting. Now combine that with the COMEX coverage ratio. The CME warehouse report shows registered silver inventory at approximately 103 million ounces against 429 million ounces of open interest. That is a 13.6% coverage ratio, below the historic danger threshold of 15%. Each ounce of registered physical silver is backing more than 7 paper ounces. The futures inversion and the coverage ratio are two different instruments playing the same note. Something is pulling metal out of the deliverable system, and the forward market is beginning to price that stress. Now, I want to walk you through the weekend gap mechanics specifically, because this is something that a lot of investors understand in theory, but have not thought through in terms of their own specific position right now. Markets close on Friday. They reopen Sunday evening in Asia. That is approximately 60 hours, during which geopolitical events continue to develop, but price cannot adjust. Anything that happens in that window, a missile strike, a ceasefire announcement, a diplomatic breakthrough, an oil supply disruption, gets priced in all at once when liquidity returns. The result is a gap. The price opens Monday at a level materially different from where it closed Friday, with no intermediate price discovery. For holders of physical allocated metal, a gap is interesting but not existential. Your position does not change, your metal does not move, and you either wake up wealthier or you reassess your thesis. For holders of leveraged futures or options positions, a gap is a different kind of event entirely. Think of it like a plumber in Manchester who has booked a job for Monday morning at an agreed rate. Over the weekend, the cost of every material he needs doubles due to something completely outside his control. He shows up Monday, and the economics of the job have completely changed, but the contract was written at Friday prices. That is a gap event for a leveraged position. The agreement was made in one environment. The Monday reality is a different environment, and there is no opportunity to renegotiate in between. The Iran situation is the specific geopolitical variable that makes this weekend's gap risk elevated above a normal Friday close. Oil prices have moved sharply higher this week already on conflict risk. The Strait of Hormuz, through which a significant proportion of global oil supply flows, is directly in play in any escalation scenario. Gold and silver have a well-documented response to oil price shocks through the inflation channel. An oil price spike feeds into inflation expectations, which feeds into safe haven demand for gold, which pulls silver higher in its wake. The reverse is also true. A ceasefire or diplomatic announcement removes the geopolitical premium, oil falls, inflation expectations soften, gold gives back some of its recent gains, and silver, which has the additional macro headwind of elevated real yields, retreats further. Both directions are live going into Sunday evening. If you know someone who is sitting on a silver position right now and not sure whether to hold through the weekend, share this video with them immediately. This is exactly the framework they need before markets close today. Let me bring in the bigger structural picture because I want to make sure you are not making a short-term decision without the medium-term context. The Shanghai Gold Exchange is currently showing physical silver at a premium of approximately $4 to $7 per ounce above COMEX-derived pricing. That is a 5 to 8% spread. Before you take that number at face value, let me give you the honest caveat. Shanghai premiums can reflect local taxes, import duties, financing costs, and currency controls, not purely physical scarcity. I am not presenting this as definitive proof that Chinese buyers are physically draining COMEX vaults. What I am saying is that when you have a futures inversion, a 13.6% coverage ratio, and a persistent Shanghai premium all pointing in the same direction simultaneously, these are not coincidences. They are three instruments in the same orchestra. Asian industrial buyers, solar manufacturers, electronics producers, cannot substitute a paper COMEX contract for physical metal in their supply chain. They need the ounces. They are paying the premium because they have to. The World Gold Council data on central bank gold accumulation adds the sovereign layer to this picture. These institutions are not making tactical trades. When a central bank moves reserves into gold, that is a multi-year structural allocation decision. It reflects institutional judgment about the dollar-based financial system that the day-to-day headlines rarely capture. De-dollarization is a decade-long process. It is not a Monday event. But the direction of travel is documented, and the Shanghai premium is one of its most visible current expressions. The Bank of England reserve data and LBMA vault figures also reflect consistent physical activity. For UK investors holding silver in a SIPP, the allocated versus unallocated distinction has never been more directly relevant. Unallocated silver is a paper claim. In a coverage ratio stress event, paper claims are what get tested first. The industrial demand underpinning all of this does not disappear because of a weekend gap event. The Silver Institute data shows a structural multi-year deficit in silver supply versus demand. Solar panel manufacturing, electronics, EV components, medical devices. Silver is embedded in the physical infrastructure of the global energy transition, and you cannot see it burning the way you can watch oil being consumed. It is dispersed across massive industrial systems in tiny quantities that are rarely recovered efficiently. The UK's North Sea energy transition and the domestic solar rollout that the ONS has been tracking are direct contributors to that structural demand. I am not going to give you a precise ounce per megawatt figure because that would be false precision. What the Silver Institute data shows is the direction, and the direction of industrial demand for silver has not reversed. A weekend gap event, in either direction, does not change that structural reality. What it changes is the short-term entry and exit arithmetic for anyone who is leveraged or thinking about adjusting their position. All right, let me show you how I am thinking about all of this right now using the 3 lanes framework. This is how I separate the noise from what actually matters, and I run it identically every single week. Lane 1 is the paper market. The CFTC Commitments of Traders report shows managed money net longs in silver in cleanup mode. Hedge fund positioning is below its 12-month average. Lower speculative positioning means less paper froth, but it also means less of a counterweight when physical demand reasserts. The futures inversion in the May contract at $83.87 against spot at $85.40 is the paper market's own internal signal of forward delivery stress. That is not a retail observation. That is the futures market itself, pricing something uncomfortable about the near-term physical picture. Lane 2 is the physical market. CME warehouse report, 103 million ounces registered, 13.6% coverage ratio, 23% decline over 30 days. Shanghai premium, $4 to $7 per ounce persistent. Physical market is showing tightness that the futures price has not yet fully absorbed. Lane 3 is macro. DXY 99.40, headwind present. 10-year at 4.26%, real yields elevated. PCE near 3%, Fed is trapped. Iran conflict, active and unresolved going into the weekend. In 15 years watching currency and commodity markets, the combination of a futures inversion, a below-threshold coverage ratio, and an active geopolitical wildcard going into a 60-hour market closure is one of the more unusual setups I have seen for a Friday close. I am not saying it resolves dramatically. Markets have a remarkable ability to absorb pressure without breaking. What I am saying is that the conditions for a significant gap event are present in a way they are not on a typical Friday. When the paper lane is showing internal stress signals, the physical lane is at structural warning levels, and the macro lane includes a live geopolitical variable with a 60-hour news blackout. The historical pattern is that Monday opens carry more variance than usual. That is a framework. You decide what to do with it. Here is my one specific call for this week. I am watching the FOMC statement on Wednesday, March 18th, but more specifically, I am watching gold's reaction in the 2 hours immediately following that statement. One thing, here is why I have narrowed it to that window rather than the statement itself. The statement will tell us the Fed's language. The gold price reaction in the first 2 hours will tell us whether the market believes it. If the statement is hawkish, inflation concern dominant, no flexibility on rates, and gold drops but holds above $5,000 in that 2-hour window, that is institutional buyers absorbing the hawkish headline. That is the floor being tested and held. If gold drops through $5,000 on a hawkish statement, that changes the picture meaningfully. If the statement is neutral or dovish and gold moves above $5,200 within 2 hours, the geopolitical and macro tailwinds are combining and the physical silver story has direct fuel. My one call, watch gold in the 2 hours following the March 18th FOMC statement at 2 p.m. Eastern. The $5,000 level on the downside and the $5,200 level on the upside are the thresholds. This is my call for the week. John, FX Insider. On record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is a video about gap risk, and I owe you genuine balance, not a directional pitch. Here's what needs to happen for the optimistic picture to develop into Monday. Iran escalates over the weekend. An oil supply disruption or military escalation triggers a flight to safety. Gold gaps above $5,200 at the Sunday evening open. Silver follows, potentially opening above $90. The futures open interest on COMEX spikes further, and the coverage ratio approaches single digits, forcing the physical story into the mainstream conversation. The Shanghai premium widens above 10% as Asian buyers accelerate purchases ahead of a potential squeeze. Every component of that scenario is a plausible continuation of what is already in motion. Now here is the cautious picture. A ceasefire announcement or diplomatic progress over the weekend removes the geopolitical premium entirely. Gold gaps down toward $4,900 to $4,950 at the Sunday open. Silver retreats toward $80 to $82. The DXY rallies above 101 on a safe haven dollar bid. The eligible to registered reclassification mechanism on COMEX activates, relieving the coverage ratio pressure, and the physical squeeze narrative deflates. That scenario is equally real. The Iran situation has produced surprises in both directions this week already. Both outcomes are genuinely possible right now, and anyone telling you they know which one is coming is telling you something that is not true. Your job is not to predict the outcome. Your job is to know which outcome is developing when markets open Sunday evening, and to have thought through your response before that moment arrives, not in reaction to it. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who need this analysis before Friday close. Hit it now. I want to ask you 2 things, and I genuinely want your answers. First, are you holding physical allocated silver, paper silver exposure, or both going into this weekend? Be specific if you can. Knowing how this audience is actually positioned helps me make the analysis more useful for you. Second, given the futures inversion we covered today, does the gap between the May contract at $83.87 and spot at $85.40 change how you are thinking about your silver exposure right now? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are coming back to this exact moment. I will open with what happened at the Monday gap, whether gold held $5,000 after the FOMC, and exactly what the coverage ratio looks like after whatever plays out this weekend. That is a return visit worth being here for. And if someone in your life is sitting on a silver position right now and heading into the weekend without a framework for thinking about gap risk, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.